Today, we will talk about cash flow from financing activities. Cash flow from financing activities is a section of a company's cash flow statement, which shows the net flows of cash that are used to fund the company. Financing activities include transactions involving debt, equity, and dividends. Cash flow from financing activities provides investors with insight into a company's financial strength and how well a company's capital structure is managed. Investors and analysts will use the following formula and calculation to determine if a business is on sound financial footing. CFF equals SED, where SED equals cash inflows from issuing equity or debt, CD equals cash paid as dividends, RP equals repurchase of debt and equity. As an example, let's say a company has the following information in the financing activities section of its cash flow statement. The cash flow statement is one of the three main financial statements that show the state of a company's financial health. The other two important statements are the balance sheet and income statement. The cash flow statement measures the cash generated or used by a company during a given period. Investors can also get information about CFF activities from the balance sheet's equity and long-term debt sections and possibly the footnotes. CFF indicates the means through which a company raises cash to maintain or grow its operations. A company's source of capital can be from either debt or equity. When a company takes on debt, it typically does so by issuing bonds or taking a loan from the bank. When a company goes through the equity route, it issues stock to investors who purchase the stock for a share in the company. Debt and equity financing are reflected in the cash flow from financing section, which varies with the different capital structures, dividend policies, or debt terms that companies may have. A positive number for cash flow from financing activities means more money is flowing into the company than flowing out, which increases the company's assets. Negative CFF numbers can mean the company is servicing debt, but can also mean the company is retiring debt or making dividend payments and stock repurchases, which investors might be glad to see. Any significant changes in cash flow from financing activities should prompt investors to investigate the transactions. When analyzing a company's cash flow statement, it is important to consider each of the various sections that contribute to the overall change in its cash position. Companies report cash flow from financing activities in their annual 10-K reports to shareholders. For example, for the fiscal year ended January 31, 2022, Walmart's cash flow from financing activities resulted in a net cash flow of minus $22.83 billion. The components of its financing activities for the year are listed in the table below. Here are three key takeaways. 1. Cash flow from financing activities is a section of a company's cash flow statement, which shows the net flows of cash that are used to fund the company. 2. Financing activities include transactions involving debt, equity, and dividends. 3. Debt and equity financing are reflected in the cash flow from financing section, which varies with the different capital structures, dividend policies, or debt terms that companies may have. Hope this would help. Thanks for watching.